right. Well, um, everyone, we are live. It is, what is today? Today is March 12th. It's a Wednesday. Um, and we are talking everyone's favorite this time of year, tax planning. It's Matt Donaghue and Jason Duffaut with Mission Financial Planners. Our brilliant tax attorney, refer relationship, Nathaniel Landman is taking time out of his incredibly busy season of the year to be a guest panelist for us today. And what we're going to talk about is really just tax planning. I know the title of the workshop is the new retirement rules, understanding the Secure Act 2.0, but it is all about tax planning, folks. How do the plans that you're using at work or your IRAs work today? What is that going to mean for you tomorrow? What does it mean for those of you who are retired and maybe you're dealing with RMDs or other things? If you're an employer, what does it mean for you in terms of, should I be offering programs like this at work? Or if I am offering programs, am I doing the right thing? Not just by my employers or by my employees, of course, but also for me as the employer. Am I doing the right thing? And we'll wrap up today. We'll give you a little example of a tax analysis that we do. But it's something that when we offer it and when we do it with people, the biggest thing I always want to point out is your tax professional, whether it's someone like Nathaniel or your CPA or your enrolled agent or your tax preparer, they're the person who actually files the return, whether it's a business, a real thorny issue, like something that Nathaniel might get involved in as a tax attorney, or something that if you're going down to just your local tax preparer you've always used, right? That's the person who's going to ultimately sign any of the returns or anything like that. But before we jump into it, just by way of introduction, I know a lot of you have met me over the years. Some of you have never met me. You've worked with Jason over the years. So I'm Matt Donaghue. I'm one of the managing members at Mission Financial Planners. I have about 25 years of experience overall. We founded Mission Financial Planners in the depths of COVID. It was actually November of 20, so why not, right? And then I was fortunate enough to have known Jason for many years. He joined the firm as a managing member in in January of 23. But that's my quick introduction. Jason, go ahead and introduce yourself, and then Than, I'll tee you up as well.
Yeah, thanks, Matt. Like Matt said, we've known each other for about 15 years. We finally found a way to work together in 2023 when we came together in January. I've been in this business for 25 years and worked in many different forms and fashions, from bank channels to working at an actual family office where we had integrations with law, tax, and the investment planning side of everything from that end. So got together with Matt and Ken, and we've been building a holistic financial planning practice since then, and been pretty successful with it. And I think people are pretty satisfied with the integrations that we do and making sure they get the big picture on everything.
Great. And then thank you, Jason. And then Than, we started working together, what, about 2 years ago? Does that sound right?
Things like that. That sounds right.
Something
And
like
and
that.
and at 23, yes.
Yeah.
Yeah.
So tell us a little bit more about your career and how you have progressed as a tax attorney over the years.
I'm been in practice for about 35 years now. I got my LLM in tax from SMU up the road in Dallas, and through for family reasons, we settled in Missouri and been pretty much a solo practitioner the whole time. I represent people before the IRS and help settle their debts. In certain situations, eliminate them. And I also prepare about 300 tax returns a year, including this year's probably 55 different businesses. So I do it from a compliance and a controversy standpoint, where I look at everything as an issue that can be resolved uh, and through a different window than other tax preparers. I don't like my clients to have to owe anything. So if there's a mechanism that the code allows us to use, I'm going to recommend that, as long as we follow what the code says to avoid the having to pay the taxes. That's pretty
Got it.
much my attitude. And then the other my other attitude is you always have to prepare for when the IRS is coming. It's a better way of living as opposed to if they come. So that doesn't prevent you from taking advanced tax minimization techniques, just as long as on your P's and Q's and I's and T's, we're fine. So
Absolutely. Thank you. Thanks for sharing. Let's go ahead and jump into it. All right. Secure Act 2.0. Secure Act came out. It really introduced just about 100 new rules that individuals and businesses are affected by. And the impact of it really is pretty significant, right? It changes the way that you save for retirement. It changes the way you're going to fund your retirement. And if you're a business owner, it's probably going to change some of the ways you think about the plans you offer for your employees, regardless of whether you're a big employer or a small employer. Now, even though we have Than on with us today, this is not tax advice. This is just informational. We always have to say that when we do one of these workshops. But let's get into it. So there's 4 main keys we're going to go through today. First key is really geared more towards the individual in terms of how the Secure Act affects you directly. Than and Jason, I know that RMDs are something that a lot of people don't really think about as they're getting ready for retirement. It's really when they get in their early 70s, it seems like for a lot of people, the light bulb finally goes on. Can you guys just talk a little bit about RMDs and why it's so significant the RMD age got pushed back, and maybe some of the ways people could be managing the RMDs in light of the Secure Act changes?
Sure. I think a huge thing with the RMDs is people don't really look at them until, like you said, they're in their early 70s and they're like, oh, goodness, I have a gigantic RMD that's coming due and it's going to continue to come due. And I'm just going to have to suck it up and pay the tax on that. And yeah, I guess that's one way to look at it. The other way would be let's do some preemptive strategies like Than would talk about around, how to reduce these RMDs, how to get more tax strategies in to eliminate some of that tax. Maybe that's in alignment with your core values and what you want to accomplish, the goals that you have.
and you'll note on the screen there's RMDs eliminated for Roth 401k, 403b, and 457b accounts. So that's a very significant element for people who work in hospitals or schools and have 403bs. You certainly want to plan for that. There are ways that the Secure Act came out because the Congress wanted to remind everybody the idea of retirement planning was actually plan for retirement and not pass on this large amount of wealth to your children. So they want you to spend it while you're living. But there are ways to, everybody has different situations, and there are some other ways to pull money out of your 401ks in a tax minimized way. And, if you have questions about that, about your particular situation, the three of us can certainly advise you on that.
Absolutely. Absolutely. All right, let me clear my drawing there quick, and let's move on. Hey everyone, it's Matt Donaghue. If you want to see how this video really applies to you and your personal situation, get a hold of us. You can always call us at 888-339-0093. Once again, 888-339-0093. You can email us at admin@mfplanners.com. Once again, that's admin@mfplanners.com. Otherwise, go to our website, www.missionfinancialplanners.com. Once again, www.missionfinancialplanners.com, and just click on the About Us tab, and you'll be able to schedule one-on-one time with either me, Kenneth Hamilton, or Jason Duffaut. We're all certified financial planners. We're all standing by, ready to help. All right. This happens quite a bit. Your spouse passes, of course, one spouse passes away before the other spouse, but one of the things that changed just last year was how a surviving spouse can now adopt a younger spouse's RMD schedule. So then I don't know if you've seen that in your career, but Jason, I'm sure you have. How significant is that? for that surviving spouse.
That's pretty huge. I mean, we've had spouses come through here that have had 18-year age gaps. And, but, normally you expect the older spouse to pass away, but that no one can control that. And when it happens in reverse, I mean, that is the a huge equivalent of how much more RMD they have to take if they have to adopt the younger spouse's RMD, or adopt their IRA and follow their own older RMD schedule. Whereas if they're following their deceased spouse's schedule, I mean, it's just so much less that they have to take. So it honestly, I'm very surprised that was built in, because it's a huge advantage to the clients.
So just to paint the picture real clear. So let's say somebody is 75, their spouse is 65. The 65-year-old spouse dies, right? The 75-year-old, and just to clarify for everybody, the 75-year-old has their RMD schedule on their money, but they don't have to adopt, or they can adopt the 65-year-old's RMD schedule for that money. Is that correct? Right.
That's right.
Okay. Okay. That is a big deal. If you have a big age gap, that is a big deal. This is one that I've always found interesting, and for those of you who attended our Social Security workshops in the past, I tend to tell family stories a lot. My dad's a great example of this. He didn't retire until he was 78. He had earned income. He loved what he did. And I always used to talk about him just in a Social Security standpoint, where he filed for Social Security at 65, which was his full retirement age. And then he double dipped basically. He got 13 years of Social Security, got his full income. Social Security recalculated his benefit every year, so his benefit went up in addition to the cost of living adjustments. I mean, it worked out great from a Social Security standpoint for him. Well, I know my dad well enough to know that if he could have continued contributing to an IRA, and he's 86 now, right? So this was many years ago. If he could have contributed to an IRA for those last 6.5, 7.5 years before he retired, he would have. He absolutely would have, because he has just always been a saver his entire life. So if you're someone who likes what you do, it's fantastic that you can keep saving. Now, I'll throw it over to Jason and Nathaniel, though. If you and your spouse are both in this mix, you're talking what, 14, 15, what is it, 14, 16,000 a year between the two of them? What's that mean from a tax planning standpoint if they're both still working?
Well, I mean, basically can minimize their taxes by being able to do this kind of contribution, which didn't have before. So that's a big deal too.
Yeah.
So yes.
Yeah. All right. Dan, you talked a little bit about how workplace has changed. If you're out of work at 55, you can pull money without penalty. If you're still employed, though, the catch-up schedules have drastically changed. And do you guys want to take a minute and talk about this, not just from the employee standpoint, but also, like if an employer is out there considering putting something like this in, what it could mean for the employer to put in a retirement plan for work?
Yeah, I would say, the biggest thing for the employer, especially for the employer-employee relationship, is that they've put these new rules in place. An employer can actually, make a matching contribution to a Roth, which is somewhat unheard of in the past. We've never seen that before, and that's kind of a huge uptick for the employee to be able to get that type of benefit, and for the employer to be able to advertise that they have those type of benefits to give to those employees. So that's probably for me, having done many retirement plan setup, that's a huge change in the law. And
So,
then,
sorry, Jason. So as the employee then, right, if I can get my match in a Roth, what does that mean for me? That means taxable income today, but no taxable income later, right?
yeah, you can get a pretty
Yeah.
big pool of
Yeah.
tax-free income.
So sorry, Dan, sounded like you wanted to add something
And
too.
and if you're self-employed, you're running your own business, you basically can shelter quite a bit of money in a 401k, deferring your income and to the business, and you can contribute to the 401k there. And the company would match you set the match for the company, so you can filter a lot of income away from taxes now, in addition to the Roth element too. But if you still want to use traditional, then you can you know there isn't a percentage of income requirement for 401k contributions. So if you gross 50,000 or you're in your business, throwing a number out, and you can defer all of that, you would have zero tax income, and you're deferring all your income. That's a pretty good deal too. So
And I can't imagine anybody wants zero income tax, right? Right. So, so folks, the takeaway from this is if you're an employee and you're in some of these catch-up age brackets that you can see here, make sure you're taking advantage of them. And if you want to spend some time one-on-one with us to talk through it, by all means, right? By all means. But also think about what Than said. If you are an employer, even if you're just self-employed, you do need to look at how do these plans save you money on taxes now, but also start building that retirement savings for you. Because one thing we've seen over the years, if you are a business owner, a lot of business owners have all their money tied up in their business. This is a good way to save some money today by lowering your tax bill, but also build up a whole nother nest egg to go alongside your business at the same time. So, whether you're just an employee, I shouldn't say it like that, whether you're an employee or whether you're an employer, this is important stuff for you either way. And if you want some guidance on it, just let us know. We're happy to have a follow-up conversation. So here's just a breakdown, a little more visual of the catch-up contribution. So those of you who are under 50 who are on the call, good job being here, but it doesn't apply to you. Standard catch up from 50 to 59, 60 to 63, and then you can see 64. So that 60 to 63 window is interesting, right? It goes up to 10% or 150% of $7,500. So, Than, if someone's looking to do an enhanced catch up this year, or I should say for the 24 tax year, is it like an IRA where they can still do that, or is it that's already on the books? Forget about it. It's in the calendar year. You're done.
oh no, you have until the day you file your return to make the catch up.
Yeah. So that's a huge deal, guys. If you're in any one of these age brackets where you can take advantage of the catch up, you should be talking to your tax professional about that to make sure you're doing it. It'll
I
lower your
often
tax.
do.
Oh, go ahead.
I often file extensions for that purpose, to give my clients 5 extra months to make the catch-up contribution, and then when they file in October, they don't
Mhm.
know their tax liability is zero because they've caught up
Yeah.
for the previous year.
That,
Yes.
so hopefully everyone's getting that. But like I said, we are recording today as well. So if you want to review this, we'll have it. So you might be thinking about putting more money away for retirement. Well, the Secure Act also gives you a couple more options. Okay. One of the things that when Roth 401ks first came out, it was fantastic because now like Than said, you didn't have percentage of income requirements and so on. You could just elect the Roth option at work. You did have RMDs for Roth accounts though, and that finally got eliminated in 2024. So now a Roth in an employer-sponsored plan no longer has the RMD requirement like a traditional 401k or a traditional IRA would. You do have the option with the catch-up contributions for the higher wage earners to have that money go into the Roth account as well. So the Roth now functions, the Roth 401k, I should say, the Roth 403b, 457 now functions much more like your Roth account that you opened for yourself as well. Auto enrollment changed. Employer can defer 3 to 10% of your salary in year one. Years 2 and beyond, it can go from 10 to 15%. Than, can you talk a little bit about how auto enrollment might be able to save some payroll taxes and things like that, not just maybe for the employer, but potentially for the employee as well? Or does it matter?
Well, I mean, it matters because if you work for a company that has 10 or more employees, I don't think it applies to people that have less than 10 employees. You're automatically enrolled in one of these things. So before that, you had to elect to enroll. Uh, so the automatic enrolling allows you to you don't even see it. You don't even have to think about it, but a portion of your salary is going into retirement. Again, lowering your taxes because it's reducing your salary by the contribution. So, so it's supposed to be easier for employees to participate when before it wasn't. So
Got
I
it.
think that's the theory behind it.
Does it help the employer in terms of reducing some payroll costs as well?
Well, I mean, the employer gets a credit for setting up the plan, which they're required to do. They get it, so all the costs associated with that. Obviously, if the employer likes its employees, determine the amount of match that it will match the contributions. So if the employer wants to keep their employees, they may offer a higher match. And again, that's a reduction of tax liability, but for the employer as well. So yeah, there's lots of advantages. The employees, if you're an employer of more than 10 employees, you have to set one of these plans up. But the tax savings, because you do it, offsets any of the costs related to it.
Yeah. Yeah. Annuities are now in 401k plans. That's something that, and Jason, you might want to talk about this a little bit. We still tend to see annuities in the retirement plans that are offered by insurance companies. But Jason, do you want to elaborate a little bit on this about how this might be a little different than that?
Yeah, this one's a little different because these are qualified longevity annuities that they put inside of these 401k plans. So they basically say that you could take a portion of the 401k that you have and use something like this. The reason they really did it is because people biggest concern was running out of money at an older or an advanced age. So they put these in to try to segment some of the money into something like this, where the money you can have your own personal pension, if you would, that would keep paying for as long as you live. And they did put some stipulations around how much could go in, so they limited it to about 200,000 as the maximum amount that you can put in. But the upside is when you do use the tool appropriately, it has to be a qualified tool that's used. There's only certain annuities that meet that requirement that the IRS has. But when you do use it, it does that part of the money can not be counted when calculating the RMD. But a payment must start at an advanced age when you have to start taking money from that qualified annuity.
Yeah, and folks, we're not, as you all know, we're financial planners. We're not annuity salespeople. So, with the annuities, the type of annuity Jason's talking about is essentially, and you can look this up, it's the deferred income annuity. You'll see it referred to as a QLAC as well. But essentially, what happens, a portion of the savings goes into that, and it's usually at either age 80 or 85 is when the income from the annuity would start. But it does serve as sort of a guaranteed income portion for you, if you will, that's also exempt from RMD requirements up until it starts. So it can help, right? It can help, especially if you're concerned about stable income later on as well.
Well,
Now,
if I can add, in
mhm.
today's environment, the word guarantee is particularly attractive to people looking at retirement. So that's the biggest advantage of these things is you're going to guarantee a certain stream of income and you won't lose your initial deposit. So
Right, right. And this is just for the compliance folks out there. We always have to say guarantees, and you'll see it in the fine print, subject to the claims paying ability of the issuing insurance company. But Than, you're absolutely right. It's guaranteed by the insurance company. I mean, you have the right insurance company in the mix. It's a solid guarantee. It absolutely is. Um, 401k plans for small businesses. Now, I know you guys could talk for the rest of the hour on this. Give us some insight into how the Secure Act changed 401k plans for small businesses.
I would say with the starter 401k, it just kind of opened up the market. Traditionally, if you weren't going to be contributing a certain amount of money, most of the 401k vendors or providers did not want to deal with the administration of that 401k. Now they've created a starter 401k, which, yes, it's still a 401k, but it smells and looks similar to an IRA or a simple IRA where it's very easy to set up, and the contributions don't have to be large. They can be small nominal contributions, and it can be all be voluntary, meaning I don't have to provide a match if I don't want as an employer. Now, does it help you to provide a match? Sure, it gives more benefits that you give to people that makes them want to work for you. But nonetheless, it's a great way to get these employees started and get yourself started with that process so they get in the habit of savings, which is what they're trying to accomplish with the Secure Act.
Right. Right. What about it for part-time?
The part-time part got interesting. They really wanted the workforce that only did part-time. So think sometimes you have spouses that are dealing with their family, taking care of their family household and do some part-time work. Maybe the kids are in school, they're working part-time when the kids are in school. When the kids are not in school, they're there and available from that end. What they did with the part-time is said basically if you're putting in 500 hours a year for 3 years, then the employer has to make the plan eligible for. In the past, they didn't have to. If you didn't have the 1,000 or 2,000 hour, used to be 2,000, but the 2,000 hour limit, then sorry, you were ineligible and you couldn't participate. Even if you just want to volunteer your own money and not get a match from that end. So
This also helps people that are taking Social Security. You could do a part-time job, and again, you could defer your earnings into the 401k and then protect your Social Security payments from being taxable because you don't pass the income threshold. But you get out of the house and you're doing something, you're peopling or whatever, you're making a little money, uh, but you're properly planned. We're deferring the excess, so your taxes are not affected by that. So it helps lower your taxes.
Yeah, and we actually have a lot of people on the call today who fit that exact category. They got the part-time
Yeah.
job in retirement, and it's exactly what, for the reason you said, Dan, it gets them out of the house, keeps them busy, and yeah, there's no point in blowing up your Social Security or anything else, to protect your mental health. Take advantage of the 401k plan, and if they offer one. If they don't offer one, see what they can do to offer one. Ask. I'm sure.
If they got more than 10 employees, they have to. They have
Yeah,
to offer.
there you go. There you go. SEP and simple plans. There were some changes there. There's Roth options now. Guys, you want to talk about that?
yeah, that's pretty huge. I mean, the simple is, like I said, it's the easy way to get into the retirement space. Now that they've added the Roth feature and the employer and you can actually put some money into a Roth simple, once again, you're building up your tax-free bucket, doing normal habitual savings that you want to do anyway. The SEP IRA is purely employer contributed from that end. So an employee doesn't get to put contributions in. Only the employee doesn't get to put contributions in. Only the employer does. And with being able to do that Roth, granted the employer is still paying tax on those dollars, but putting it in there is a huge benefit to the end user, which is the employee.
Yeah, and we're right at the bottom of the hour, so just a quick time check for everyone. And also just one housekeeping item. I know I forgot to mention it at the beginning of the call. If you do have questions, feel free to ask as we go. Put them in the chat, put them in the Q&A. I've seen one question come in the Q&A. We're gonna probably wrap up in about 15 minutes. We'll have plenty of time for Q&A within the hour here. But please feel free to ask. Put your questions in the chat or the Q&A, and then we'll make sure we get to them at the end of the presentation. Emergency savings accounts are available as well. It's not for highly compensated individuals, but $1,000 a year could go into it if you're trying to build an emergency plan at work. That can provide some flexibility as well. There are some options for qualified student loan payments though, and your employer has the ability to make a matching contribution to your retirement account, and you can then use those contributions for qualified student loan payments. Now, I think in bold at the bottom there, it's an important point. Graduate and postdoc students are also eligible for IRA contributions. So when we're thinking about student loan help, and I know, we have some households we help with college planning. I wouldn't, I don't want to speak for Jason, of course, but it's not a core part of our business. It's not a huge part of our business. But when you think about that, if you do have, um, the matching contribution, um, you, coming out of college, right? It might help you manage that student loan payment in a tax efficient manner. Um, unless I'm misreading that.
Yeah, and I would say too, though, Matt, a lot of times. Oh, go ahead, Than.
Go ahead.
I would say too, though, Matt, a lot of times the challenge has been that you have these student loans, you go back and you go into the workforce and you can't afford to put money in your retirement plan
Sure.
because your student loan bill is so large
Right.
that you have to pay that, right? And probably the articles and the studies that I've read said that, the huge advantage to this is that it now gives the employer the ability to put a match in, even though you're paying your student loan payment from that end. So they treat it as if you were actually contributing that student loan payment to a retirement plan so the employer can match and isn't stuck in a position where they say, oh, Matt, I'm sorry you didn't put any money in. I can't match, right? Which then sets you way behind on your retirement plan because it could take 10 years to pay off student loans.
Sure. Sure. Dan, anything you want to add?
I would just be wary of student loan payment planning given today Congress. They don't like to give breaks for student loan things that what may have been on the books may come off of the books this summer. You know, I'd be just a little wary of this, any kind of arrangement going forward. I really need to pay attention to what's happening and coming out of Congress regarding this because the general attitude towards student loans is to make people pay them. So
Mm-hmm.
I don't, I'll just be a little wary. That'd be my caveat. We do have a question about that. I don't think parent student loans qualify, plus loans. I think it's only the individual employee's student loan that qualifies for that student loan payment thing. But I'll double check that.
Regarding the lifetime income estimate, pretty much if you log into your 401k today and check it, they all show this, right? Here's what your estimated income is going to be, and some of the plans incorporate in Social Security and stuff like that too. The one warning, or I'd say caution I would give people on those estimates is they are just estimates and they are only really based on that account. Maybe they're incorporating Social Security in some way, but you do want to look at a bigger plan than just that. So it can be useful, right? But just make sure it fits with all the other moving pieces you have. All right, so other ways it can help. New ways to use your money. This might go a little bit. I know we have a question outstanding about donor advised funds as well. So this might, and we have a follow-up to it. From a qualified charitable distribution maximums, those are now being indexed for inflation. Most people do know what qualified charitable distributions are at this point. Just in case you don't, starting at 70 and a half, if you directly move money out of your IRA to a qualifying charity, it counts as the RMD. It also doesn't count for taxes up to 100,000. I haven't checked what the number looks like for 25, but is it 105, Jason?
I think it's 105.
105. But, the qualified charitable distribution works there. Now, it may be a little bit of a tangent, but then we've had a couple questions come in on donor advised funds. Can opening a donor advised fund reduce taxes in any given year? And especially with the SALT deduction hopefully increasing, right? What implications do you have there?
Donor any kind of charitable planning is a good idea. Donor advised funds, it's a revocable gift. You get to pick the investment and you get to pick the charity. grows tax free. The only thing is that's all you get. If you're interested in utilizing charitable giving for additional retirement options, there are ways to structure charitable giving that you get a benefit from in addition to the charitable deduction. I'm not a big fan of donor advised funds for that reason, because it's a gift. You get the charitable deduction if you qualify, if you can itemize. And this year the threshold is $30,000 for married, 15 for single. So if your charitable deduction, 60% of that is all you get credit for. So you have to donate $50,000 or more to get the benefit, and then that's all you get. We reduce our taxes a little bit, and you get to pick the charity. If you use charitable trusts, then there's different kinds of charitable trusts. You also get a stream of income from that, as well as the charitable gift, and pick how it's invested and pick the charity. So I like trusts better than donor advised funds for that reason. But yes, it would reduce if you qualify to itemize. Donor advised funds are a good way to get a charitable deduction and control who gets it and when they get it. So.
All right, going back into the and Than, I saw your note on the question. Going back into the college planning for a second here, using a 529 account to pay off student loans. I guess my big question on this, Than, does the beneficiary of the 529, is that the person's? I'm assuming that's the person who has to.
That's the student.
It's the student, right? It's not the
Right.
parent of the student or the sibling of
No.
the student. It's the
No,
student.
it's the parent.
Okay.
It's the student. Now, the caveat is if the kid doesn't go to school, you can change the beneficiaries to other people.
Mm-hmm.
And those people, if those people have student loan, then those people can use it to pay their student loan. And it has to be their student loans. It can't be plus loans or whatever else.
So the key would
like
be. Oh, sorry. Go ahead.
I like to tell people, if parents of small children, what if they don't go to college? Well, you know what? There's a surfing school in Hawaii. You can change you can change the qualifiers. You can change the beneficiary to yourself, and you can take a vacation in Hawaii and learn how to surf on your 529 plan. So
there you go.
there's cooking schools all over the world that qualify. So if your kid doesn't go to college, it's not necessarily the end of the world. So.
There you go. There you go. That's Jason now knows what I'm going to use my kid's 529 for. I'm going to use it to go to guitar school. That's exactly what I'm going to do. See, we all get something out of these. We all get something. Parents can roll 35,000 of 529 funds as well into a beneficiary's Roth. It's pretty straightforward. Now, the one wrinkle, and this might confuse people, the one wrinkle, 529 has to have been in effect for 15 years, subject to the 35,000 lifetime cap and annual contribution limits, which are currently 7,000. So, guys, just to be clear, does this mean 7,000 a year for 5 years, or does this mean I can move 35,000 at once?
Annual contribution limit is the annual contribution limit.
So you're moving 7,000 a year out of the 529 to a maximum of 35,000.
Right.
Yeah, the slide's not worded. Super clear. Long-term care insurance. So you can withdraw, and this is something that, I spend a lot of time talking about long-term care planning with people. You can pull $2,500 annually from your company's retirement plan, penalty free. That's the key word, folks. Penalty free, not income tax free. Okay, so you could be 50 years old. You went out and bought your long-term care because you listened to me and Jason, and we told you do it at 50 because it's affordable and you're healthy, and that's the right time to do it. You pull your $2,500 out to do it. Well, guess what? You will pay income taxes on the $2,500 that came out. You just don't pay the 10% surcharge on top of it. So just, it's still going to be income tax to you, but you could use the funds if you wanted to pay for those long-term care policies. One last note on the type of long-term care. It has to be a qualified long-term care policy, LTCI. That means traditional long-term care insurance. It can't be a life insurance policy that has a long-term care rider on it. It's got to be an actual, just plain vanilla long-term care policy.
And
Um,
if I could add a caveat,
yeah.
proper planning though
Hmm.
would could possibly eliminate any tax liability, even with that kind of withdrawal.
There you go. There you go.
Very true.
All right. You have you have a kid, you have children, right? You can take out 5,000 for qualified birth or adoption expenses without the 10% early withdrawal. Um, just do it within 12 months of the birth or adoption. Um, and I think Than's point about the long-term care, uh, I think probably holds true here is planning, 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 right? Um, just because you don't think something's going to happen doesn't mean it won't happen, or you might not, or you won't have an opportunity to use some of these provisions. And you can see as well, there's some other things as well. If you're terminally ill, there's a domestic abuse situation. Um, you're a public safety worker, which by the way now does include firefighters, but there's exemptions for that as well. All right. This is probably the thing that, at least in personal financial planning, comes up a lot is what happens to my
Mhm.
IRA when I die. Specifically, if my kids are going to be the beneficiaries, what happens? I'm going to punt this one over to Jason because I know I talk about this all the time with people. But Jason, what do you think?
I think, from all the good things the Secure Act did, when it came to people that have large IRAs, this has been a brutal
Yeah,
pain point for them because they've
yeah,
had to accelerate the taxes substantially. I can tell you stories of I've had clients. I've got one young man who inherited his dad's IRA in 2019, which is before all of this went into effect, and he's on a stretch IRA provision. His $500,000 IRA will go forever, and he only has to take a nominal amount out every time instead of liquidating the entire thing in 10 years from that end. So the tax impact on the planning structures that we do has been ginormous from that end.
yeah,
And in some of those cases, we've actually worked with Dan to say, hey, how do we circumvent this, right? Yes, they put this rule in, but there's got to be a way to still have some type of modified stretch. So maybe that's something you can talk about too, Dan, is, how do you deal with these big changes when
Thanks.
they punch you in the head with them?
Thanks. Yeah, I mean the old stretch for your lifetime is not there. It's you have 10 years, so you can plan for it. Uh, that's why Jason and Matt exist. Uh, we know we're going to have this tax bill if we invest properly when we take it out from the investment, and we don't have to do it the first year. We can wait till year 10. So you can invest the money and then have that tax bill paid from those investments. There's really not much of a way around this. It's a 10-year thing. It's due, in those 10 years wait, you and uh, it's due if you pull it out. That that's when it's due. So if you don't wait 10 years to pull it out, you got to pay it the year you pull it out, but you only have 10 years to pull it out. So the better thing would be, okay, I'm going to have this bill in 10 years. Let me invest this money to pay it. That's really the thing. And then we can use some charitable or other techniques to address the individual's situation to offset it. Or if you're in business, we can use some business. There are ways to plan for it. Again, planning is the best way to do it. A lot of my clients, they took that check, they put it in their bank, and then 6 months later they came to me, what's my tax problem? Like, it's big. Not much I can do 6 months after the fact.
right.
Please. So, if anything, before you do anything with these, check with your advisor. Matt and Jason are fantastic. I would certainly check with them. If you're not already a client, please become one because they will give you great advice on what to do with these kinds of things. So,
Yeah, and this goes into exactly what Dan said, right? The death of the stretch IRA just means that the planning side of this is more important than ever. So, four key things you can take away from today's workshop. One is if you're still in savings mode, right? Know what the catch-up provisions are, know how the savings plan options have changed. We threw a lot of terminology at you today. We threw Roth versus traditional. We threw catch-up provision. We threw, oh, it's from this age bracket to that age bracket. We threw a whole bunch of stuff there. So while you have more time to save for retirement, you have more ways to save for retirement. Please remember, if you are an employer or you run a small business or you're an entrepreneur and just doing your own thing, you can take advantage of this from that employer standpoint as well. So you want to make sure you have a conversation with either me or Jason, maybe we pull Than into the conversation when it's appropriate, but have a conversation about, hey, how do some of these things actually apply to me and to what I'm trying to do? You do have more options in terms of the ways you can use your money. Than said it several times, and I think it's worth repeating. You can use the money in some of the new ways the Secure Act has talked about. However, if you do a little planning ahead of time, you might be able to magnify the way you use that money, right? And that could be really meaningful in some ways. And then finally, the death of the stretch IRA. There's a lot of different tools available for you to pass assets from one generation to another, even for people who their IRA is their big asset. That's okay. There is some planning you can do to try to minimize that. I'm going to throw a couple pieces in the chat, but before I do that, let me just stop my share for a second. I'm going to pull something else up, and this is something that Jason and I do, and so does Ken as well, for those of you who know Ken Hamilton, who's one of the other managing members here. So this is a tax analysis that we'll do for people. And let me pull it up here. Okay. So this is a sample report. Let me zoom in a little bit. Oops, too far. Okay. So I'm looking up to my left here. That's the screen I'm sharing. So this is a sample report. It gives you some key figures. And the point of today's workshop is not to take you through this whole report, but I want to take you through the end of the report, where it shows you pretty clearly, here are some of these modified adjusted gross income planning considerations. So like when Than's talking about tax planning, when Jason's talking about tax planning, am I above or under the threshold where I can take advantage of some of these things? What is my implication from, if I'm going to do Roth IRAs, do I just have to do the 401k at work? Do I have the option to still do maybe the backdoor Roth IRA? What are some of the other things I can do, right? And when you look at this, it's one of those things that it helps you have a benchmark in terms of where you are. So whether you're having us do that on last year's return, on this year's return, it's definitely worth having done. And it's something that, as certified financial planners, we do it. Keep in mind what I said at the beginning of the hour, though. We cannot do your taxes for you, right? Your tax preparer, your enrolled agent, your CPA, your tax attorney, those are the people who can actually file the taxes on your return. We can do analysis and work with people like Than to help you make good decisions and take advantage of the planning opportunities that are there. But it's got to be a team approach. It can't just be us telling you to do it, then you go do it, right? We got to pull that tax professional into the conversation. So let me throw that. And in fact, what I'll do, because we've had some problems with Zoom today, in the follow-up email that goes out to everyone, you're going to see a copy of this. You're going to see a copy of the handout. We're going to get this recorded on, we did record today, so we're going to get this onto YouTube as well. So you'll get a link to the recording today as well. But that should hopefully come out later today or early tomorrow morning. Gentlemen, we're at 51 minutes. We still have everybody on, so we must have done something right. Nobody left. Follow-up, final thoughts from you guys. Than, I'll turn it over to you, and then over to Jason.
I just can't emphasize the importance of pre-planning. It's a lot harder to fix tax returns after the fact than it is anticipating some of these changes. But there's a lot of opportunity here for tax savings, and one should certainly look at that. I'm pragmatic when I advise my clients. So, some people say only do Roth. I like to do, hey, whatever fits your situation best. It may benefit you to do half Roth, half some sort of combination of traditional and rock. And certainly there are ways to minimize your taxes with these new changes going forward.
All right, thank you. Jason.
Yeah, I'm going to echo what Dan just said, which was, your situation. I mean, we had a client many years ago that were doing the holistic planning with estate planning, and she was doing exactly what Dan is saying. She was doing part Roth conversion, but on the back end, the IRA was too big to Roth convert it in a comfortable manner for her, and in this case, to get it all done. So what she did is she just attached a charitable design on the back. So all the money would flow into the charitable trust and then could be distributed over the lifetime of those people that she wanted to benefit from that end. So it's all about your situation, designing it to your situation and what's important to you. Between Dan and I, we know almost everything that's going to come down the pipe. It's just a matter of, can we make it match to what's important to you?
Yeah, and that's the goal at Mission Financial Planners, folks, is to find what matters to you and then hopefully deliver it. I mean, that is everything we do, and we want to make sure you're making an informed decision along the way. So what I'll say in wrapping up, thank you so much for your time. If you do have a question, feel free to reach out to me or Jason directly. You can always call us toll free at 888-339-0093. But I know you've all got our personal, or I shouldn't say personal, our work contact information. Get a hold of us if you do have a question. We'll also be following up in the next couple days as well, to see what specific questions you might have and see if you want to do that tax analysis. Keep an eye out for that email that's coming out either later today or tomorrow morning. It'll come from Mission Financial Planners. It'll have a link to the recording for this. It will also have that report, that sample report I talked about. It'll have the handout that accompanies this workshop as well. But everyone, thank you again for your time. We really appreciate it. And have a great rest of your week. It looks like we had one question come in. And it was, and Jason, I'm going to ask you this. Describe your process for a tax analysis and its cost.
So the tax analysis process is basically, we get your tax returns, we do exactly an analysis process and come out with that output that Matt showed earlier. Cost-wise, it depends on what we're analyzing, honestly. It depends on if it's just an individual 1040 or if it's something that's more sophisticated where we're dealing with business tax returns and a 1040 together. Then if business returns are involved, then THAN is involved, and we have to figure out what that fee would be. So it'd be best to start with just a conversation to understand where you are in that spot. Are you just a 1040 or are you more than just a 1040?
Right. Great. Last call for questions. All right. Thank you again, everyone. We really appreciate your time. Hey everyone, it's Matt Donaghue with Mission Financial Planners. I hope you're enjoying this video. Make sure you like and subscribe and share our YouTube channel with your friends and family. There's a lot of great information here that a lot of people need to know. So don't forget, like and subscribe, and feel free to reach out to us if you have any questions.